Today we'll finish up our discussion of Taleb and get into some of these others. We'll be doing Kahneman and Hubbard as separate videos, and I want you to see what they say directly versus listening to me talk about them, and then I'll give you some help to understand their concepts, and some quizzes that you can walk through to make sure you're capturing all that, and then get into Annie Duke as well. Right, so we said for Taleb, the first thing he says is we over rely on a normal distribution. The second thing he said was we get paid for just pure random luck. It looks like skill because we did well, but it's just pure random luck. The third thing he says is very closely related to that, is we're often fooled by randomness. We like to see patterns because that's our job. We want to be able to tell people, oh, we see something, every time this happens, this happens. So we see a pattern, we create a model, we sell it to the public. They see random noise and mistake it for information. The problem is not that our ideas are sticky. The problem is that our ideas are sticky. Once we produce a theory, we're not likely to change our minds. And that gets back to investing in our egos. So you're better off delaying developing your theories. Take considerable effort to see facts while withholding judgment and resisting explanation. I love this phrase, we are better at explaining and understanding. Why? Because our bosses push us to do that, especially in an investment world. Our bosses push us to come up with some idea no one else has found before, and boy, we see some random noise and we say, oh yeah, I found it, I found the next great model. We think it is smarter to say because than to accept randomness. I love this phrase as well. Try to avoid using, in fact he has it here at the end, have the integrity to deliver your because very sparingly. Use the word because very infrequently. Instead of saying, well, the market did this because, it's better to say, well, it could have happened for these reasons, it could have happened for these reasons, or even better, I don't know. I don't know why that happened. If that's the right answer, then that's the best thing to do. Even though your boss is pushing you to give it because. I had a guy working for me who ran the precious metal fund for UTSA, and my boss was always of the opinion that the person running the precious metal fund should know what gold is worth. But if he asked this guy how much is gold worth, he says, I have no idea. And he said it I loved this guy as a presenter because he was quite refreshingly honest and just put everything out there that he knew. This is what I know, this is what I don't know. Gold does not produce a cash flow. You can't value gold as another asset. It's a purely speculative asset. So he refused to give those specific, clear answers to questions he didn't know the answer to, just because he was considered to be an expert and he needed to somehow put up this front that he knew something. He just told you what he actually believed. He had the confidence to say, I don't know. So talking about the educational system, he says it lies precisely in that it forces students to squeeze explanations out of subject matter and shames them for withholding judgment, for uttering the I don't know. I'll probably do that to you in this class, mainly because we have to get a paper out, we got to do an exam, but you got to put down what's in the rubric. But I'm always like, hey, you know what? Add your editorial comments as you go. On the paper one, the bank says they do this value at risk. I don't have confidence it's actually even doing anything for them there. It's really adding value. I think they may just be saying that because of what everybody else is saying. If that's what you really believe, now be careful that you don't start just making stuff up because you want to sound like you're really seeing between the lines. But say, what do you really know? What do you really believe? What does the data tell you? If you don't know, say you don't know and don't make stuff up. He actually says, and this is one reason I read The Economist and not the Wall Street Journal, is listening to the news every hour, every day. Wall Street Journal, they got to fill up this newspaper. Probably the majority of what they're putting in their newspaper is noise. It's not important. It's not really information at all. But they got to fill up a newspaper. When you read something that's published once a week, a lot of that noise gets filtered out, and it's not that important. If you want to know how horrible newspapers are in reporting noise, then he recommends spend a year reading the previous week's newspapers. That comes out of that fourth book. Right, so the fourth thing he says, he is very negative on experts. He says experts and elites know far less than we think they do. We rarely go back and assess how accurate they were. There are people that are talking heads on TV, and they're not talking heads on TV because of how good their forecasts are. People on TV are on TV because of how much confidence they exude. It's that the TVs are looking for, the TV programs are looking for. Information, rather than those who provide no tangible added value, are generally dealing with the future. So I'm not saying that no one who deals with the future provides any valuable information. What he's saying is those who provide no tangible added value are generally those who are dealing with the future. The problem with experts is that they do not know what they do not know. They are quite ashamed to say anything outlandish to your clients. That gets back to what we said before. When there's no money on the line, you're not going to say something crazy. You want to keep your clients. It's career risk. You're gonna say something that's pretty much inside the normal box. The problem with experts, they do not know what they don't know. They don't want to be outlandish, and yet events, it turns out, are almost always outlandish. We saw that in 2020. We saw that in 2008. We saw that in 2000. We saw that in 94. We saw that in 87. Economic forecasters tend to fall closer to one another than to the resulting outcome. In a study comparing investment analysts with weather forecasters, I hate to tell you all this, but these two gentlemen find that analysts are worse at predicting while having greater faith. So we're worse in our forecasts in finance than weathermen and weatherwomen are, and we're more confident in our skills. Those who had a big reputation were worse predictors than those who had none. So again, TV programs are looking for confident people, not knowledgeable people. The fifth thing he likes to say here is that massive rare events explain what is going on in the world. Those are the most important thing. I think this may be one of the most critical thing. I get this with students a lot that want me to tell them exactly what to do in their career, what job to take, where to go next. And what you're going to find is the most important decisions you make in your life are not the ones that you sit down and plan out hour after hour and carefully plan. The most important decisions you make in your life are going to be those things that happen in a moment without complete unexpectation. I was sitting at my desk at UTSA in a job as an accountant. Accounting, I was doing very, very well as an accountant. I was rising up through the ranks, getting promoted, had a great reputation with my bosses. I was making presentations, everything was going great. I had a career as an accountant, had no interest in changing, but I had a CFO who liked people working for him that are always talking about career and looking at advancement. And he usually did not walk. He had this person who worked for him who was in the back corner. He rarely walked by my desk when he went to that person's office. But for one day, for some reason, he walked by my desk. He took a right when he normally didn't take a right. And I thought, well, I've got to get some points with the boss. So I just said, just to say something to him, that I saw this job on the board, looked interesting, what do you think? I really wasn't interested in it. I just wanted to impress him that, I was looking out for my career. It was a job in finance. I didn't want to go to finance. I loved accounting. I was doing great in accounting. That was my career. I got my CPA already. He walks back to his office, calls the head of that department, and I was working there 2 weeks later. And it radically changed my whole career. Now, what would have happened if he had not turned right down that aisle? I don't think I would have ever gone into finance. I mean, it's kind of interesting. And if you look, and the job I went into, that job, the guy running that department, he had a hard time making decisions. He had posted that job in the Wall Street Journal. He had interviewed a lot of people, and he was in a lot of trouble. At that point, he was in a lot of trouble because his boss was mad at him for not hiring anyone already. So when my boss's boss called him, the CFO of my company called him and said, hey, this guy Ron Sweet is interested in your job, that guy is like, okay, I got to make a decision now. And the timing was absolutely perfect. And I was scared to death because I really didn't want that job. I was doing so well where I was. It's like, what have I done to myself? And boy, it worked out perfectly. That is a black swan. That's an event completely out of left field, a few seconds of my life, and was more important than the previous 36 months of my life. I mean, it's just that's what a black swan is. And that is what your career is going to be. So all this planning and stressing that you're doing, that's fine. But the most important things that are going to happen to your life are going to be these completely random things, seem completely random activities that are going to change everything. Whom you marry, where you work, a particular person you run into and suddenly you've got a new job. Those are the things that are going to really dictate your life. I can say, going back through my life and looking down at the black swans I had, there was about 4 or 5 of them that were absolutely, one of the biggest in my career was an opportunity came up and it absolutely leapfrogged my career massively, only because my boss happened to be out of the office that day. And my boss had been in the office that day, he would have taken the project and I wouldn't have gotten it. You can't plan those kind of things. And that's what he's saying. Is finance, we're trying to do all this planning and forecasting. We're looking at history, looking at distributions. He's saying that doesn't work because the most important things are out of left field. They're completely unexpected. You'll never predict them. You'll never forecast them. And yet they're the single most important things that happen. That's a pretty radical idea. It really makes it unnerving. How do you actually function in finance if that's the case? But what he says is we ignore those events, those black swan events, because they're rare, they're hard to predict, and yet they're ultimately the only thing that really ends up mattering in our lives. A small number of black swans explain almost everything in our world. The normal is often irrelevant. Life is the cumulative effect of a handful of significant shocks. History doesn't crawl, it jumps. This implies the need to use the extreme event as the starting point. You notice how I kept saying, look at the extremes, and not to treat it as an exception to be pushed under the rug. The future will increasingly be less predictable. He actually predicts going forward, he predicted several years ago, and it seems like he got it just right, that you'll have several years of incredible stability. You should go back to 2017 and just see how incredibly stable the stock market was. For several years of just incredible stability, followed by a year like 2020, where you just had upheaval that we've never seen before. And before that, everything had been smooth. And then you had 2008 was unlike anything we'd seen before. And before that, it was all very smooth. And then you had 2000. And we're seeing that 2000 was a huge event, but 2008 was even a huger event. And then 2020 was even a huger. Things happened in 2020 that we have never even imagined would be possible. Like the jobless claims. The jobless claims we saw in 2020, every jobless claim we've seen starting in March of 2020 would have set a record before 2019, before 2020. Every single jobless claim was higher than the record high ever recorded jobless claim number we had seen through February of 2019. It's just incredible, the numbers we were seeing. And that's his idea. The world is going to be smooth, and then the next crisis is going to be bigger because we're so interconnected. So the black swans, not only did they define everything, but they're getting bigger because we're so much more interconnected. And he talks about it with flight, and I've seen this. How often have you arrived 1, 3 hours, 6 hours late for a flight? I've arrived 24 hours late from a flight. How many times have you arrived 1, 3 hours, 6 hours early on a flight? So things are skewed. They're not normally distributed. We talk about worst case scenario stress testing. You saw a lot of that in paper 1. But the problem is your worst case scenario, when it happened, it was greater than the previous worst case scenario. So the worst case is, what we're seeing now, according to him, is each worst case is greater than the previous worst case because things are actually getting bigger, they're getting much wilder. I showed you that article from Glenn Holton. He was talking about these big events like you saw Nick Leeson and what he caused at the Queens Bank. And you saw those numbers, 1.5 billion, Orange County, we'll talk about Orange County, 2 billion, 1.8 billion. Those numbers look so puny given what happened in 2008, and it looks so small given what happened in 2020. Think about 2020. Airlines saw their revenues drop 80-90%. No, if anyone had said in December 2019 Yeah, one of the scenarios I want to run is airline revenues dropping 80-90%. People would have thought you had lost your mind. So, 2020 has taught us that, boy, these worst case scenarios, they can really become much, much, much worse, more than we can even imagine. So, um, yeah, but it's hard to do this on a job. You go out that far on the limb because most of the time you're going to be wrong. Most of the time you say, hey, what about a scenario of revenues dropping 80%? Well, that's not going to happen very frequently. It hasn't happened in the last 100 years. So, yeah, it's pretty wild. But we were talking about the pandemic. I remember George W. Bush, boy, during his presidency, he was talking about a pandemic and how serious it could be. He had really good data and analysis. He was looking at some information from some of his scientists, and he was very concerned about it back then. People were talking about this kind of stuff. Not that it would happen next year or the next year, but if you're talking about a worst case scenario, that's one of those worst case scenarios. So what do you do with this? It's just something you're going to have to figure out in your career. A lot of people say there's nothing we can do about it. We can't manage our clients' portfolios thinking the next year is going to be the next 2008 or next 2020, but those years are going to happen. Should you try, when I talk about my option strategies, are there times where you do try to cut off the extremes of the tail, realizing that you may be giving up 0.5, 1% of your return, and 5, 6, 7 years, that's a lot of return to give up. So you can save 40% in a one disastrous year, because it's possible you could go many years without that disastrous year. So it's difficult. I'm not saying this is easy, that once you acknowledge this, it's easy to know exactly what to do, because it's not. The next thing he says is we're easily fooled by calmness. So markets are calm for the longest time, and our memories of the last crisis go away. We prefer risk with low volatility, but with huge downside risk. We actually love calmness, even though that calmness may end up in a 60% loss all at once, because we just love the calmness. It's that Russian roulette example he was talking about. And the extremes, we'll talk about this with Doug Hubbard. He makes this case that when you go to the extremes, everything changes, because you have what's called contagion. Things that were unrelated suddenly become related. So people are often ashamed of losses, so they engage in strategies that produce very little volatility but contain large downside. Like he calls it collecting nickels in front of steamrollers. Now he compares this, and I love this comparison. I've been watching airline videos about plane crashes and the investigations afterwards, and it is an amazing thing. The detail that the airline industry goes through after every crash to understand exactly what went wrong. So every plane crash brings everyone closer to safety, improves the system. These are wonderful documentaries. I would, recommend that you read them, you watch them. They're quite fascinating. Sometimes there's a flaw in the construction of the airline, and so the airline has to change how they build their planes. Sometimes there's a flaw in the maintenance. I saw several of them where the maintenance people just didn't follow procedures correctly, and so they actually changed the procedures to make sure there's a double check on those. Sometimes it's the training of the pilots, and there's some of the ones they'll look at it and they say, why did the pilot do that? That's really strange. And then they'll look back at the official training that the airline was doing, and they said, well, the airline was actually training the pilot to do that in that situation, and so they had to change the training procedures. Sometimes it could be something like the procedures at the airport, how planes were taxied. It could be the controllers. It could be a weather-related item. What happens with de-icing planes? What if, so there's so many things in every single plane crash. They want to know exactly what happened, and then they want to make changes so that that doesn't happen again. That's an incredibly strong risk management system. These systems learn because they are anti-fragile and set up to exploit small error. We'll talk about anti-fragile here a little bit, what he means by that. So these the airline industry, they take advantage of small error in order to fix things. You remember earlier when we were talking about operational risk, is to look at those close calls and understand those close calls so you can learn from those, and that's what the airline does. So they don't just do these investigations when there's a crash and there's a lot of lives lost. They do it for every emergency landing. When something goes wrong that could have been a disaster, they go back and review that very, very closely. There's one video where they show, where you've heard of Sully, the guy who landed on the Hudson. There's also another plane that landed actually in just on this, next to these waterways. There was a flat land. They landed, and the people on the plane said it was one of the smoothest landings they'd ever had, but it was a crash landing. Everybody survived in those plane emergencies, and yet they still went out and investigated what happened with the Hudson landing. It was a bunch of birds that flew into the engines. Well, that made them change the way engines were protected from birds. So each one becomes a lesson learned. So even the smallest error where there's no loss of life, and even in that one where they landed on that strip next to the waterway, the plane wasn't even damaged. They completely saved the plane. No one was injured. Their luggage was fine. Everything was like a very normal landing, except it just wasn't at the airport. So you can't say that about economic crashes, because the economic system is not anti-fragile. I guess we better define anti-fragile here, and we'll come back to it again. That's the term he invented. A fragile person is someone who is unhinged by volatility. Volatility destroys them. And then there are people who are just resilient. Resilient means volatility hurts them, but they survive. They're survivors. They do well. They come out stronger. It was painful. But then there's anti-fragile. Anti-fragile, that's someone who actually excels in volatility. They love volatility. They do well in black swans. That's my option strategy, where the markets blow up and your options more than offset your losses, so you actually gain. So the market's down 40%, your portfolio is down 40%, but your options put you up 50%, so you have a net, you're up 10%. That's anti-fragile. So they do mediocre most of the time, but at the tails, they do extremely well. That's anti-fragile. So he's saying airlines are anti-fragile. They actually benefit from volatility, from errors. Now, obviously, it's bad if passengers lose their lives or pilots and flight attendants lose their lives. That's not good. But the airline industry itself becomes better because of that accident. He's saying the economic system is not anti-fragile. The economic system is not resilient. It's actually fragile. There are hundreds of thousands of plane flights every year, and they're not related to each other. They're not correlated to each other. They're independent events. That gives the airlines a huge advantage. There is not a contagion. It's not like, wow, that airline crashed, so suddenly all these others can crash. And obviously 9/11, there was a contingent event because it was a coordinated event with several planes. That's a pretty rare event, and even then, it was 4 planes. It wasn't thousands of planes. So even then, from overall, the overwhelming 99.9 something percent of the passengers on 9/11 suffered no loss whatsoever. It was very tragic, those that did, but it's still a small fraction. That is not true of the global economic systems. Errors are spread and they compound. That's the whole concept of contagion. Good systems such as airlines are set up to have small errors independent from each other, negatively correlate to each other, since mistakes lower the odds of future mistakes. We act as if finance economics is like that. That's how we plan our business, but it's not like that. We somewhat ignore the incredible contagion of the tail events. So every plane crash makes the next one less likely. Every bank crash makes the next one more likely. We'll get into this anti-fragile a little bit more, but yeah, that's what I love about that book. You'll see at the end of this section what I think is most fascinating about what he says about anti-fragile. This next thing he says is we should bet on fat tails and unexpected high volatility. Now, if you watch the Taleb Kahneman discussion, this is where Kahneman really picks on Taleb. And his main argument with Taleb is that sounds great for someone like you who's very wealthy. You can wait it out. You don't have to do well every year. But Kahneman says the average person doesn't have the time and patience to wait out those fat tails because they happen so rarely. And that was an interesting discussion there. So this one you may not buy on his argument here, but he's essentially saying we know black swans are going to happen. We know they're going to have fat tails. They happen every 5 to 10 years. So just, wait 4, 5, 6 years. You'll do average or mediocre, and then you'll do majorly well in that one great year. Think about the career risk of that. Finance is not set up for that type of managing of money. So he's saying put 10% of your money in extremely speculative bets, as leveraged as possible. And he's talking about those that are levered on the upside. So you have downside, limited risk, but you have massive upside. So a big part of the time you'll lose a bunch of your money, but you won't lose more than 100%. But a small percentage of the time you'll make 80,000%. You can have a speculative portfolio and insure it. So this is more my approach. I talked about this a little bit. Put all your money in stocks, but then hedge it. So that your average return is slightly lowered, but in those really horrible years, you do great. Now, he's not telling you to predict black swans. Do not try to predict black swans, especially don't try to predict exactly the black swan. So don't say, well, I think the next black swan is going to be a hurricane or an earthquake or it's going to be a pandemic or it's going to be one I think about that I think is really a concern given what's in the news is what happens if China does something with Taiwan. What's the U.S. going to react? How's the U.S. going to react? How's Europe going to react? How's Taiwan going to react? Especially given what China is doing, what's going on with Hong Kong. That to me is a huge risk, and President Xi of China has said he's going to resolve the Taiwan issue sometime during his presidency. Fortunately, he got himself so he can go more than 10 years. Usually they change every 10 years, but he says, I'm going to go forever. So we don't, and that was a little bit of worrying given that we thought his window of leadership was only 10 years, and he's saying he's going to solve that during his tenure. But that's a scary thought. What does that mean? That is what that could do to world economies. It could involve World War III. That could be World War III. It'd be interesting to see what's going to happen there. But that might be 10 years away. It could be next year. It could be tomorrow. Who knows? These are hard things to predict. So the key is not what black swan happened, but that a black swan would happen, and that stock market's going to fall. Interest rates will probably fall. There are some scenarios interest rates could shoot up. But all of these things have one thing, and that's asymmetry. He's saying have something in your investment portfolio that is extremely asymmetrical. That is anti-fragile. Most of the time it's mediocre, it doesn't do much, it just sits there blasé in your portfolio, but every once in a while it does great. It benefits from volatility. The idea is that in order to make a decision, you need to focus on the consequences rather than on the probability. So you need to focus on consequences. If you focus on probability, it doesn't happen that very often, so I'm going to ignore it. That's going to kill you because you know those black swans are going to happen. And again, they happen a lot more frequently than our normal distributions say they should. He says, I worry less about small failures. Now see what he's saying about career risk here, because career risk is you worry a lot about small failures. That's how you lose your job. He says, I worry less about small failures and more about large, potentially terminal ones. I worry less about embarrassment and more about missing an opportunity. I'm very aggressive when I can gain exposure to a black swan, when a failure would be of a small moment, and very conservative when I'm under threat of a negative black swan. So he's talking about skewed bets. I try to benefit from rare events, make money infrequently. The rarer the event, the more undervalued it would be priced in. This is where Kahneman says, I don't think most people have that option. Most of us don't have your wealth that we can sit around and make huge gains every 5 to 6 years. In 2020, there was an article about Taleb having this huge gain because of COVID-19, and I saw that article, a student sent it to me. But my question is, that's how he did when the market dropped almost 30%. But what happened when the market came flying back? He benefited from Black Swan, but he did get out in time. And I don't know, I haven't seen articles since. All right, so here we are, anti-fragile again. Anti-fragile is not resilience. Anti-fragile is not robustness. We're not robustness. We're not talking about people who are tough and they can withstand the pain. We're talking about people who actually benefit from randomness and uncertainty. And here's the phrase, I think this is the most interesting part of the book of Anti-Fragile. So I'm almost saying you almost don't have to read the book. This is it. What he believes is fragility can be measured. He says risk is not measurable outside of the games of chance, like cards and domino, or cards and dice, and chess, and maybe golf. There's certain things that we have pretty good statistics on, but he says for the most part, especially in finance and economics, risk is not measurable. I mentioned Glenn Holton earlier, that there's an article he wrote called Defining Risk, and the very end of that article, I think I've mentioned this earlier in the class, his final conclusion was, we cannot measure risk because we can only measure some perception of our perceived risk, but even then we're not all that sure. But the bigger question is what we're doing actually adding value? Is it of any value? So we can't measure risk, so the fact that we're measuring risk, is it of any value to us at all? So Taleb is saying the same thing. We cannot measure risk. But we can, he says we can measure fragility. I think that's really, really interesting. We can tell who are the people that are going to get destroyed by volatility and who are the people who are going to benefit, actually make hay during volatile times. This is somewhat of my theory of investing, is I want to smile when everyone is laughing, and I want to laugh when everyone is crying. It sounds very cruel. I don't mean it in a mean way where I'm actually laughing at people because they've lost money, but it's more of, I'm somewhat of a Taleb investment style. I'm mediocre most of the time, and then I do extremely well. 2008 was a good example. At first I was investing in the market. I was actually doing pretty well in the fall. I really thought we were in a trend market where it would come down, bounce up to a lower level, come down to a lower level, bounce up to a lower level. And so I was playing that game. And then around August, September, especially when we start getting close to the Lehman Brothers, I finally said, you know what? I'm head of equities. I'm in a very stressful job. I'm retiring in 2009. I've already announced that. I'm in a very stressful job. I'm very stressed out. I'm hardly sleeping. I'm retiring. The last thing I need is for my retirement portfolio to drop 40%. So I got out. I was up 16, 17% for the year at that point. Got out, put all my money into a safe, very safe, low-risk bond portfolio, and just sat there the rest of the year. So I ended up at the end of the year up 16%, and the market was down 35%. And so I kind of did just pure luck, because I finally just decided I can't take the risk. I got to get out. It was pure just, it wasn't a market timing decision. It was purely like I just can't take the stress anymore. So very, very lucky. But that was a very anti-fragile move for me to take. And sometimes you do get lucky in that. And boy, I don't know what I would have done with retirement if I'd actually lost 40% of my portfolio in that year. So, but can you wait 5, 6, 7 years for that big payoff? And that wasn't a huge payoff. I was only up 16%. But being up 16% when the market's down 30-something%, that's laughing when everyone else is crying. That's that kind of event. All right, the next thing, and the last thing is we should be careful with forecasting. I've already mentioned that. We're terrible at forecasting. We talked about that with Paul Sappho. Why on earth we predict so much? Why don't we talk about how horrible we are at predicting? Forecasts induce risk-taking. As bad as we are at forecasting, we're not any good at it, but then we use the forecast to make a decision, which is just, it's horrible. It's more toxic to us than any other form of human pollution. So there you have Taleb. And I think I captured, I don't know if Taleb were to read this, I don't know if he would say, wow, you really missed these points. But I think I captured the majority of what his points were. I still think you should read his books at least Full Door Randomness and Black Swan. I think Anti-Fragile, I think I captured it pretty well here. I'm sure he would disagree with me on that. But I think he does have something very important to say. I would strongly recommend you go out on YouTube and see some of his discussions there, see what he's saying, and pull some of the stuff for your interviews. This is really powerful added insights. Remember, what they're looking for in interviews is, first, do you know what you're talking about? Did you pay attention in class? Secondly, extremely important, are you curious? Do you have a curiosity about finance that drives you to go out and read stuff you don't have to read? And then the final thing is, I think really important for finance, is do you understand the perilous situation that we are in? Risk is the most important part of finance, and that's where we are the weakest. We don't know how to forecast. We ignore tail events, even though they define everything. I think Taleb really has put his finger on the problems of finance. Now, I had an actuary speak to my risk management class once, and one of the students asked him what he thought about Taleb. And the actuary actually got somewhat upset about the question, and he said, all that stuff Taleb's talking about, that's for you finance people. But we in actuary, we know all that. We don't do that stupid stuff. And I think that is for the most part true. I do think actuaries are much better at understanding this. And that's because actuaries, they're insuring tail events. So they better be very, very good at that side of the distribution. So I do think there's some truth to that. But I think for finance, I think Taleb is really exposing some of our weaknesses. All right, so I'm going to leave Kahneman and Hubbard. We'll come back to them. So what I want to do is go to Annie Duke. And Annie Duke, she is a professional, or she was, I think she's officially retired, American professional poker player, now a very popular author and speaker. I've seen her speak at conferences and on podcasts. She is a very, very gifted speaker. She does speak about the same stuff over and again. I haven't heard her really go out with new information. She published a second book. I thought the second book was okay. It would have been a good book. It just wasn't nearly as great as her first book, and there's a lot of overlap in the two of them. But I do strongly recommend you read her first book. It's called Thinking in Bets. Or at least read my blog. I don't know, you're probably better off reading her book, but my blog is a summary of what I learned from her book. It's not necessarily a summary of her book, because like Taleb, I probably left out some stuff she thought was really, really important. But let me get into that. I'm going to do this as a PowerPoint. I know you don't like PowerPoints, you get tired of them, but I'll definitely be commenting as I go through this. So let me show you what I learned from Annie Duke. Now remember, as we go through this, as you're taking notes, you're going to have to pick one or two of these authors and summarize in your words what you learned from this discussion. So if you want to go out there and buy Annie Duke's book and give me even more exceptional essay on the final exam, go for it. I'd be really ecstatic. Alright, so this is the presentation I built. I've made this at a few places. I built it mainly for our risk management class, but I have presented it at UTSA. I actually presented this, interestingly enough, at an actuarial conference. This was only the second time for me to speak. Well, no, I've spoken at a couple of actuarial conferences, but this is the second time I spoke where I was, the other conferences I've spoken at, I was just one seminar part of a bunch of them, but where I actually spoke to the entire body of the actuaries. And it always makes me nervous to speak to actuaries because I never know what question they're going to ask. They're very smart people. They're a lot smarter than I am, much more quantitative, much stronger math skills than I have. I still remember speaking at one conference, and after I spoke, someone raised their hand and asked me a question, and it was a very technical question. I didn't understand it. And he said in front of the entire room, there was hundreds of people in the room, he literally said, "I'll dumb it down for you." And I heard gasp in the room. People were like embarrassed that he had said that. And people afterwards were coming up and apologizing and say, "Hey, I know I'm not as smart as you guys. It doesn't bother me at all." So they're a tough crowd. So I had to find something to present. And I thought presenting Annie Duke to a bunch of actuaries, somewhat soft science, that would work. And they did like it. They didn't ask me any tough questions. And it was actually a fun presentation to do. But I do like this book. There's several books that I keep recommending over and over again. Peak and Range are two really good ones. related to how to become good at something, and it is somewhat related to this because we are talking about how to make decisions, and Peak and Range is talking about how to make decisions about your career and how you train and how you learn. Deep Work, I really like that book. So these are the books I highly recommend to college students. In fact, these 4 books are probably the 4 books that I wish existed when I was 18 years old and going into college, that I wish I could have read back then. They didn't exist when I was in college, but these would have really had an impact on how I would have gone into college and tackled college. So the whole purpose of Annie Duke's book was how do we improve the quality of decisions. And she talks some about behavioral economics and behavioral finance. That's the Kahneman that we're going to talk about. It's growing in importance. Now I know Cliff Asness, one of my favorite writers, he says, yeah, behavioral finance is really important, but there's no one out there making decisions based off of it. Now I'm not sure that's true anymore. I've seen a couple of firms who say they are absolutely using behavioral finance to make decisions. There's one firm that has hired Eugene Fama, where they're actually trying to use behavioral finance models to make decisions. But what they're trying to do is better understand economics, better understand markets, better understand human decision making under uncertainty, which all decision making is under uncertainty. If there's no uncertainty, there's no decision. I mean, if someone walks up to you and says, you have a decision, I'll pay you $1 billion or I'll pay you $100 million. Take the $1 billion. There's no uncertainty. It's 2 things. You take the $1 billion and you're done. There's really no decision making there. So we're talking about under uncertainty. By uncertainty, what we mean is there's multiple outcomes that are possible with the decision, and some of those outcomes are bad. They're negative. So how we make decisions is not consistent with the theoretical, rational-based decision-making models that economics and finance have produced. And we know that because that's what Kahneman spent his whole career studying. He took these economic models and he tested them with real live people and discovered that people don't act the way the models say, and that's important information. So the key for us is how can we take the findings of what Kahneman has discovered and others, Richard Thaler, there's others out there that have made important findings. What can we do with that? I talked some about this earlier when we did the Kahneman article, where he talked about how we can make better decisions individually and in groups to overcome those biases. So there's a lot of Annie Duke reference to Kahneman in her book. Books specifically on this topic are Thinking Fast and Slow by Kahneman. That is a book I do strongly recommend. You can watch videos where Kahneman talks. There's 3 or 4 videos where you essentially get the entire book for the video, but I do recommend you read the book. It's probably one of the most important books written. The Undoing Project I found very interesting. I have not read much Michael Lewis. In fact, this might be the only book I've read. I've heard him in podcasts. But The Undoing Project is actually his book about Kahneman and Tversky and what they discovered. It was a fascinating book, and Lewis did a good job of helping us understand Kahneman's findings and Tversky's findings by talking about the interaction of these 2 men and how they work together. And then Andrew Lowe, this is a good book. It has some issues that I wish he would have gone a different direction at the end. He kind of brings in one of the projects he's working on that he's really fascinated in and really excited about that I don't think fits this book very well, but he really wanted to talk about it, so he threw it in this book. So I wish he had done that as an appendix at the very end or something, because I think it weakens the book a little bit, because it's hard to make a connection between that and the rest of the book. He would probably disagree with that. But it is an important concept. He calls it adaptive market, his adaptive market hypothesis, where he takes the stuff that Kahneman has talked about and actually tries to make a model for decision making. James Montier wrote a book where he takes these ideas and specifically applies them to investing. Definitely, we're going to talk about Hubbard, and you'll see a lot of Hubbard's ideas, How to Measure Anything, and Hubbard also wrote The Failure of Risk Management. Both books I recommend. Today we're going to focus on Annie Duke, Thinking in Bets. So, professional poker player, played for over 20 years, over $4 million in winnings. She talks some about that career in the book. It's really fascinating stuff. So why is she using poker as her example for life? Why doesn't she use chess? Why poker and not chess? Well, in poker you face many decisions in a very compressed time frame, more compressed than in life, but still you got to make many decisions. There's statistics behind poker, no question. If you're really good at statistics, you'll probably be better at poker. There are biases. There are reasoning errors where you think something's going on. And some of these biases and reasoning errors have to do with the human factor. You have people that are actually trying to trick you with their body language. There are body languages that are biases, that people do certain things that give away what they're doing. And you may not, if you're one of those people, you may not know you're doing that. So you may have the statistics, but you don't realize that you're giving away really important information with your body language. And if you don't know that, you're going to make really bad decisions. That's part of the reasoning errors that you have. And there are strategies that you can improve your poker playing, and that all goes with life. There's statistics that we can make better decisions in life. There's biases that make us make bad decisions. We have reasoning errors. And there are strategies that can improve us. For chess is not like that at all. In chess, you would be very confident that a novice, a beginner in chess, is not going to beat a chess master. It's just not going to happen. If that happened, you wouldn't even say by luck. It wouldn't happen by luck. There is not luck in chess. A novice is going to make huge mistakes, and the master is always going to win. I remember my parents bought me a computerized chess game, and this is many years ago. This thing must be 25, 30 years old. And it's amazing. I mean, you think this stuff is pretty recent, but boy, like 30, boy, I should look. I don't think I still have this chess game. Boy, I can't remember if I kept it or not. But it had different levels. It had advanced, medium, and easy. And I could beat the easy level if I played irrationally. If I played rationally and tried to win, I could not beat the easy. The advanced level, I had no hope of beating the advanced level. I would never win. It didn't matter. No matter what I did, I could not beat. So the loser in chess will know they made a mistake. There's no randomness here. If you lose at chess, you made a mistake. Poker, a novice could beat a master their very first hand. If they're dealt 4 aces their first hand, and they've never played before, so their body language is completely all over the place. So the pro is like, wait, what's their body language telling me? They have no earthly idea. They've never played this person before. They're seeing the person all excited, and the professional saying, wow, I've seen that before. They're trying to trick me that they've got a good hand. They really don't. Yeah, the novice could actually destroy the professional their very first hand. So the loser in poker cannot always clearly see the error why they lost. In fact, they may not have made an error. I thought it was interesting, Annie Duke, when she won the championship, she admitted that the person she beat was a far better poker player than she was. And she knew she had very little chance of winning unless she did exactly what I did with the chess hand. She played a strategy that would only win, that gave her a chance to win, but a small percentage of the time. If she played normal way, she would lose probably 95% of the time. But if she did a wild and crazy strategy, she might win 15% of the time. So she tripled her probability of winning by playing this unusual strategy, and that helped her win. So she knew she didn't have a chance to win, but she played the statistics anyway and won. Poker player can make all the right decisions and still lose. And then there's bluffing and anticipating going on. So you bring in the human factor. You don't really have the human factor. You don't have the human factor in chess. So she's saying thinking in bets. What does she mean by bet? A bet is any decision about the future. Any decision you make has an outcome. So you're making a bet. She said this in her second book. A decision is a bet about future outcomes. It's a bet on the future. We can treat all decisions as a bet given that all decisions involve some level of uncertainty. And here's her main point that she starts off the book. There's often a weak connection between the quality of our decisions and the outcomes. Luck often plays a huge role in our outcomes both in poker and in life, and that can trick us. So we tend to assign quality to our good outcomes and bad luck to our bad outcomes. Something good happens, say, look how smart I was. Something bad happens, we say, wow, that was bad luck. And we tend to do the exact opposite with others. We tend to see others doing something well and we say, well, boy, you were lucky. And then someone else, something bad happens and say, well, you saw that coming, you made bad decisions. That's the human ego. And I'm already talking about that, how your ego and my ego will make us do horrible decisions because we so want to feed our egos. We so want to protect our egos and make us feel good about ourselves. She's going to talk about how you can overcome that human factor that makes us make such terrible decisions. So we rationalize our decisions to make us look better and to make us look better than other people. So she says one of the most important things to become a better decision maker is to try to distinguish between luck and decision quality. So the distinguishing between decision quality and luck is the most important thing to improve decision quality. Now we're going to study Doug Hubbard. I love what he says. He says the most important decision you will make in your life is how you make decisions. So, and that's what she's talking about, how you make decisions. How you make decisions is the most important decision you're going to make, and she's going to try to give you some ideas of how to make decisions. So she's going to start off with the mistakes that we make, and then she's going to give you strategies how to overcome those mistakes. So we'll probably have to split this between two classes, unfortunately, so we'll see how far we get. We'll definitely finish this in the next video, although you might get Hubbard and Kahneman in between that. But I'll talk about it in the email to the class, how to handle it. So it might be better not to split up Annie Duke between two different videos and have Hubbard and Kahneman. It's almost better to get Kahneman before you get Annie Duke because he draws so much on him. But I'll work that out in the class emails on how to handle this. So here's the ideas. So let's start with the first one, resulting. And she gets a lot of flack for this example. And I've had students get a lot of flack, and I can somewhat see it. But she goes back to this Super Bowl between New England and Seattle. New England is up by 4 points. There's 1 minute left. And Seattle has the ball on the 5-yard line. It's first and goal with 1 minute left. I forget how many timeouts they have. 1 or 2, I can't remember, but it's first down. And Seattle has the best running back in NFL. Everybody's thinking they're just going to hand the ball off and just pound the ball in, and that's what New England's thinking probably. But they don't do that. Seattle does a pass play on first down. They throw an interception, and the game's over, and New England wins. The next day, well, even right away, the sports announcers and the next day in the newspapers all reporting the stupid decision that Seattle made to pass the ball on first down. How stupid that was. She's referring to this as resulting. Now, I have a lot of students say, no, it really was a stupid decision. She analyzes it quite a bit in the book and talks about it. You may disagree with her decision. But the main point she's making is, and I've had some students say, no, I don't think so, Professor Sweet. So I don't know. I actually don't believe them. But that if Seattle had passed the ball on first down and had scored a touchdown, I do believe the next day the articles would have been Seattle's brilliant first down play. Because New England was expecting a run. And if you think about it, you pass on first down, maybe you have a 30% chance of a touchdown, you have a 69% chance of an incomplete pass, and you have a 1% chance of interception. If you get the touchdown, you win, supposedly, unless obviously New England could score with a minute left. But you get a touchdown, you win. You throw an incomplete pass, you've only eaten up 3 or 4 seconds, you didn't waste a timeout, and now you can run the ball, so you've got good time management. You might say, well, you could throw an interception. That's true, but if you ran the ball, there's also 1% chance. If you run the ball, there's a 1% chance of a fumble. There's a 1% chance of holding, or 10% chance of holding. So you have to look at all the statistics and see what could go on. So I don't know all the statistics. I'm not Pete Carroll. I don't know what he was looking at. But I do really believe that if they had passed the ball and gotten a touchdown, that the headlines would not have said, stupid first down call, but Seattle got lucky. I really think people would say, what a brilliant call. That was the last thing New England was expecting. Now, I think watching the play, and I don't have a video of the play, and I probably would get in trouble if I showed a video of the NFL on a class video, but I look at that play and saw a pass right in the middle of the pack, in the middle of the field. You know, I'm a UT Austin grad, and UT Austin always had this goal line pass where they would just throw it to the corner of the end zone and just see if their receiver could stretch out and bring it in. If not, it just went incomplete. So there was almost a 0% chance of interception. That kind of pass, boy, I could see that would have been a good strategy. But passing it right in the middle of the pack with defenders everywhere, boy, it seemed like the pass that he decided to pass was an extremely dangerous pass. And so, yeah, I can see that debate. But if he had passed it, you know, to the corner of the end zone, a safe pass where there's very low probability of interception, a quick pass so there's a low probability of a holding call, yeah, I could see that. But anyway, she's calling this resulting. What she means by resulting is the decision quality is assessed entirely based on the outcomes. So given the importance of luck in our outcomes, it is unfair to assess decision quality based entirely on outcomes. There's awfully often a very low correlation between the two. So she would ask clients, what was your highest quality decision last year? And people wouldn't answer that question. Instead, they would answer the question, what their best outcome was. And she would ask, well, isn't it possible your highest quality decision last year actually had a bad outcome? Why are you giving me your best outcome? Is it possible your best outcome last year was pure luck? But that's the way our mind thinks. When someone says, what was your best decision? We start thinking resulting, what was our best outcome? She says that is incredibly dangerous to decision making. The second thing she talks about is hindsight bias. We see an outcome as an inevitable consequence of our decision rather than a probabilistic one. Actually, this is my complaint about how I was taught history in high school. I was taught history in high school as if everything was a foregone conclusion. That the North was going to win the Civil War. That Lincoln was going to win the presidency over Douglas. All these were foregone. I think history should be the most interesting subject in high school. I would have loved to have a debate of what would have happened in the U.S. if Douglas had won the presidency over Lincoln. What would have happened if Franklin Delano Roosevelt had died earlier or hadn't gotten reelected? Or what would have happened if Truman hadn't dropped the atomic bombs? It's really interesting to me. My history professor interviewed Truman and discovered Truman really regretted dropping the atomic bombs. You could just tell it was probably causing him tremendous pain. Hundreds of thousands of civilians died because of that. That he really came to believe that was a bad decision. But what would have happened if they had not done that? And that's what my college professor talked about. I loved that class. I got so much out of it because he asked those questions. He asked the questions about after the Civil War. What if what if Johnson had not become Lincoln's replacement? What if a stronger president had come in? And what if the Reconstruction had gone? And really interesting, fascinating questions. But we don't think like that. We think of history as this foregone conclusion. This is the only thing that could have happened. So we think of the world as very, very orderly. We ignore false positives. That's good results after a bad decision. We ignore false negatives. Bad results after a good decision. Our brain is just not set up like that. We jump to the assumption of causation where there's really just random correlation. We cherry pick data to confirm our biases. And being aware of this is not sufficient to correct it because of our System 1, System 2 thinking. Now here she's referring to Kahneman. System 1 thinking, we'll talk about that more. System 2, that System 1 thinking, which is really quick thinking. I think I might get them mixed up here. But System 1, really deep thinking, statistically based, rationally based. And System 2 thinking, those intuition, quick decisions that we make. We tend to do more of the quick decision making without a lot of thought, without a lot of statistics, emotion driven, much more of those decisions than we really think we do. So we need to be more deliberative after the fact and actually sitting down and thinking, was that really such a bad decision? One of our clients says his worst decision was that he hired this particular person. And she went through the decision, went through everything that they did, and after she talked to him for quite a while, he came to the conclusion that actually my decisions were really good. I actually did a really good job of my decision making. I was just real unlucky with that person that ended up hiring. And so he actually felt a lot better, and that's one of the things she wants to talk about. Is one of the things we can do in this is, first of all, we won't think so great of ourselves when things come out well, because we'll give random chance some credibility and some of the accolades. But for bad decisions, we won't be so hard on ourselves. That we really did make a good effort. We really did set up our decision making well. All right, so I'm going to stop there, and we'll next video we'll finish up Annie Duke with her last few what did we do wrong, and then her ideas for how to improve it better.